Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm talking to you from New York City, specifically from Queens. It's October 15, 2019. Before I talk to you about today's show, I do want to remind you, I publish a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks. You can sign up for that by going to miningstocks.com. Also, you can call us during normal work hours, 718-457-1426. 718-457-1426 during normal work hours in New York. We also like to remind you of Chen Lin's letter, What is Chen Buying, What is Chen Selling? ChenPicks.com. ChenPicks.com is a place to go to sign up for Chen's letter, especially if you're interested in biotechs, energy, and the mining sector. Those are the areas that Chen focuses mostly on. And Michael Oliver as well. Of course, he'll be with us in just a moment. It's olivermsa.com to go for his letter and for some free stuff that's there as well, some good guidance in terms of where the markets are and his methodology, which is very unique. It's proprietary, and the reason we have Michael on every week is because he's providing something that's unique. It's not something that you can pick up off the Wall Street Journal every day. Anyway, I do want to thank all of you for listening to this show, making it one of the more listened to shows on the Voice America Business Channel. And we want to encourage you to send along your questions and comments, whatever you have to tell us in response to this show. We'd love to hear from you. You can send those along to questionsfortaylor@gmail.com, questions4taylor@gmail.com. We do want to thank our sponsors for making this show economically viable. Our sponsors for this week's show, Noble Resources, Great Bear Resources, and Irving Resources. I've titled today's show, Seeking Market Guidance from Rick Rule. So Rick Rule, Jeff Deist, and Michael Oliver are with me today. Doug Casey, who is a highly successful investor in his own right, has called Rick Rule a genius investor. For sure, Rick is anything but a follow-the-leader lemming. He's out in front of the masses shortly before markets change. His expertise has been in the energy and mining sectors, but his observation of markets and the nature of humankind are of value no matter whatever sector you're investing in. Rick is an avowed lover of liberty and free markets. Most importantly, he lives those values in his personal life. I've known Rick personally for a number of years. We'll ask him what to make of the existing political and market environment and how he plans to survive the troubled waters that appear to lie in front of us. And he'll be on with us during the second half of today's show. Right after our first commercial break, we will also seek Jeff Deist's thoughts about the current political disunity in America and what that may mean for the markets and our lives in general in the coming years. But right now, I'm happy to tell you, once again, Michael Oliver is with me to give his latest thoughts on the markets based on his proprietary work. Thanks for joining me again, Michael.
Good to be back, Jay.
Yeah, it's always good to have you every week. You are our most frequent guest. And that's for a reason, because I just keep finding your work to be very, very helpful to me personally, and I think to many of our listeners as well. And I hope that at least some of those listeners out there are subscribing to your service, because I think they'll benefit very greatly from it. Especially if you're a longer-term investor and not a day trader. I don't know that even you would suggest that's the greatest, that your service is the greatest for that. But in terms of understanding whether you're on the right side of a market from a longer-term perspective, I don't know of anybody that's ever been better for me personally, and so I want to thank you for coming on again. Well, recently you noted that gold has risen significantly in value without the benefit of a weaker dollar or declining stock market, and commodities in general weren't doing all that well. They were just sort of treading water. You suggested that we might need to see some of these other asset categories, like the dollar or equities, head downward before we see gold breaking out of its congestion area right around the 1,500 mark, plus or minus that side of 1,500. And then you see 1,700 as the first major resistance in a longer-term bull market. But what's your momentum work telling you now in terms of some of these key markets? Specifically, I think you're looking at the dollar and T-bonds, perhaps, right?
Yeah, there's certain asset categories that have not made a statement yet, and two of those would be the Bloomberg Commodity Index. They're going sideways since 2016, and they've developed a structure above them on momentum, not so clear on price, that says if we can get above that structure, we're going to take off upside. Meaning, finally, commodities will say, we're with you, gold. Okay, there's some commodity price inflation here, and we think it could be sharp and significant. So we're monitoring that, and we're literally less than 1 point on the Bloomberg Commodity Index from closing a month out above our key structure. Okay, next category, stock market. The S&P has waffled sideways since January of 2018. It's had some big drops and some big rallies, but if you just look at the sideways action since that time, it's we're pushing on 2 years here in 3 months. We're all of a handful of percentage points above that high. So it's really not been a good performer for long-term investors. It indicates to me, and technically it's more evident, that long-term investors in the stock market are in some stage of doubt. That's why the market hasn't moved much higher than it was in January of 2018. With ups and downs, so the doubt is expressed both ways, but net on balance, it's effectively sideways. So are most developed economy stock markets. T-bond market, we're watching for that to turn down because I think the downturn there will help infuse more capital out of that market and into the gold market. T-bond market. T-bond market or government bonds in general. It'd be the Bunds in Germany, the JGBs in Japan, and our T-bonds. I'm not talking about high-risk debt. We're talking about government debt now. Has surged strongly over the last 6 months or so. Actually, since December, we turned bullish last December on T-bonds. And they've had a heck of a nice up move. And it's not driven by the Fed or anything. We're talking about long-term debt here, so it's more market forces move it. And the problem is now, technically, we can see the potential, and we can't call it. We know the numbers, and we're waiting on a monthly close this month. But both all these three markets, the JG, Japanese government bonds, the Bunds, and the UST bond futures, are all very close to registering levels that if they close out the month below, will indicate, this advance in price and drop in yields is over. Now, at first you might say, well, that could be good for stocks because it indicates that people are vacating this alternative to stocks. Well, maybe so. But figure it out. Do you think rising rates in the long end of the government bond market means something positive for the stock market? Okay, net on balance? I doubt it. It also indicates that, what does that mean? Does that mean that the central banks who supposedly, quote, control government debt markets are out of control? Because if these markets break down, they've created egregious errors in the process of getting up to where they are, meaning as low of yields as they've generated. And therefore, it could be a very dangerous wreck if the T-bond market, the Bunds, and the JGBs turn down. It's not been a threat to the stock market up to this point, but it could become one. So we're watching that more keenly than we are actually the stock market. And also watching the Bloomberg Commodity Index because it looks extremely potent for a rapid upturn, meaning you come out of a quiet 3+ year period of action where everybody's asleep at the switch, and you have across-the-board commodity strength, and that's pretty much what we're seeing the potential for. And if that happens, what will that do to the debt markets? We have commodity price inflation.
Yeah.
So all of a sudden you throw into the mix here a wrench of commodity price inflation, and I'm talking about the sort of percentages. If the Bloomberg turns up, we think it could surge 20% rapidly.
Wow.
Now, that's a headline event, and that's also very disturbing to all kinds of assumptions about central bank policy and central banks being in charge. All those forces could drive gold much higher.
Right. Well, certainly if you start seeing rates rising, which nobody expects, everybody's sort of buying the idea that we're going to see rates falling, even U.S. rates into negative territory potentially, that would certainly shake some confidence, wouldn't it? I mean, the idea that the central banks are in charge and that they have everything under control. And if then they start pushing money into the system anyway because of a lack of liquidity or whatever, and prices continue to rise, and if it becomes apparent that the central banks no longer have control.
Absolutely. It's a sentiment issue as well, yeah.
then confidence is lost. But, you just have to look at the the global economy now. I mean, people, let's say pension fund managers, they have to go out and they have to find yield somewhere. So they've been going out in the equity markets with these low rates, and the treasury rates and the safe rates, and they're going out taking on all this risk. And we've had as you pointed out numerous times in this show, we've had a sideways market pretty much. I mean, the equity market's gone nowhere over 2 or 3 years. So if people are running pension funds are depending on equities to get their yields, to get their cash flow to pay off their pensioners, and then all of a sudden the equity market goes south. Well, you would think they would be piling back into the bond market, into the treasury markets, but then if you start having all this inflation at the same time, that could cause some nervousness, and I certainly cause people to look at gold again. It seems like some of the smarter investors are. One piece you wrote recently, waiting for a dark cloud to lift. I guess, could you just pass along your thoughts there on that? I mean, I understand it.
The dark cloud that we're all focused on probably over the last year or so has been the trade war, of course. And at least it's been defined and compartmentalized to some extent, and it's sort of worn down in terms of its perceived threat. Not that it's solved, but it's at least compartmentalized now, and there's a first step taken forward and so forth. And so the market has looked at this over the last several days and said, well, no, it's not perfect, but at least we can sort of define it better. And it's on the right course, et cetera, et cetera. China has shown they're willing. Whatever. Anyway, it's to some extent compartmentalized as best you can without actually solving it. So that's out of the way. But the other big issue was, months ago, the Fed isn't accommodative enough. Okay, well, they've cut twice, and they're likely to cut a third time. This harkens back to 2007, by the way. As we were topping, there were 3 rate cuts in a 3-month period. So they've cut, but forgetting that, they've gone into a new QE, and they deny that they have, but quantitatively you can see that they have. And so they've gotten very aggressive and accommodative. Okay, so that issue of the non-accommodative Fed is off the table. They're now in sync with their brothers overseas at the Bank of Japan and the ECB, et cetera. So all these 2 big possible negatives have now shifted to positive, or at least to not a threat. In which case, okay, the party should be on. Let's see you guys take it up. The S&P, big time. Okay, if they do and it doesn't hold, or if they don't take it up, that's going to cause even more fear and doubt among the doubters out there. People are still holding some long position in the stock market, but are a little queasy. It is exhibited by a year and a half of sideways action up here in the high, around 2,900 either side of. So, again, those dark clouds have lifted. Okay, let's see the party. Certainly, and that's the propaganda anyway. There's no QE. Everything is just fine and dandy, and and then if you start getting some inflation and some rising yields, and people are nervous about the stock market. It's not going anywhere for several years, and now all of a sudden you can get a couple of 3-4% in the equity in the bond markets and the treasury markets. You could see where it could unravel pretty quickly in the equity markets. But who knows for sure, Michael? I guess that's why we depend on you, because your proven methodologies that you're using for many years, you've developed them over the years, your proprietary models are really very helpful in helping us determine whether we are at this moment on the right side of a market or not. I want to thank you very much once again for being with us, and look forward to hopefully to having you back again next week. Thank you, Jay.